Part 1. Opening. The Tsubaki Senka on the bathroom shelf welcome their third owner. You wake up in the morning and open the bathroom door. You wash your hair with the red bottle of Tsubaki shampoo, squeeze some Senka foam cleanser into your palm, work up a lather, and wash your face. Next to the sink sits Uno Skincare, and in summer, an ENG Deo 24 spray that every member of the family reaches for. None of these are anything special. Familiar names that have filled countless bathrooms across Asia for decades. Yet almost no consumer realizes that the brands on this ordinary shelf have changed hands 3 times in the past 5 years. These brands originally belonged to Shiseido, the major Japanese cosmetics conglomerate. After Shiseido announced it would concentrate on its high-end prestige business and spun off these mass-market brands, the European private equity firm CVC Capital Partners acquired them and built them into a company called Fine Today Holdings. Then, in 2026, CVC sold the company again, this time to the American private equity firm Bain Capital for roughly 200 billion yen. Nothing changed in the consumer's bathroom, but the capital structure that owns those brands has now been redesigned 3 times over. In today's session, we're going to look past the surface-level valuation of the Fine Today deal and examine the structural core logic and control mechanisms engineered beneath it. Part 2. Structure Breakdown. Not growth. An already finished 21% margin. Market headlines frame this deal as a fallback option, something close to a fire sale, forced on a company that had failed to go public twice. But once you take the structure apart, the reality is the exact opposite. The true driver of this deal isn't a growth narrative. It's a completed asset. The margin reconstruction that the seller, CVC, had already finished building over the previous 5 years. Fine Today posted revenue of roughly 107.3 billion yen in 2024 and about 56.6 billion yen in the first half of 2025. While its adjusted EBITDA margin improved markedly from 15.5% in 2024 to 21% in the first half of 2025. In other words, what Bain acquired was not a company that will get better, but a company that had already gotten better and then went on the block. Let me explain why this distinction is decisive. From a valuation standpoint, the acquisition price of roughly 200 billion yen works out to about 12 times on a 2024 reported EBITDA basis, or roughly 8 times on an annualized first half 2025 adjusted EBITDA basis. Given that global consumer staples companies typically trade between 12 times and 18 times EBITDA, Bain's entry multiple is, on paper, clearly discounted. And here, the designer's eye must ask one and only one question. Is this discount-free margin that Bain captured by being smarter than everyone else? Or is it the price of risk that the market has legitimately assigned to this asset? My judgment is that it's overwhelmingly the latter. 2 failed IPOs and 1 collapsed sale to a Chinese buyer are the verdict the market has already handed down on this asset's growth premium. The fact that CVC was the party that created the value is also a key to understanding where the center of gravity in this deal really sits. After carving the business out of Shiseido for roughly 160 billion yen in 2021, CVC rebuilt an organization that had been skewed toward R&D and marketing into an integrated company, equipped with its own manufacturing and sales functions. In late 2023, it acquired Shiseido's Vietnam plant, securing its first overseas production base and a halal-certified manufacturing hub. The result was the margin improvement I mentioned earlier, and yet, the money multiple on this deal, buying at 160 billion and selling at 200 billion, comes to just about 1.25 times. The fact that 5 years of ownership and a 5.5 percentage point lift in margin, produced only that much in sale gains, tells us that most of this asset's value appreciation came not from multiple expansion, but from pure margin improvement. It's a cold signal that the market had no willingness to pay a higher multiple for this company. This is where the true character of the deal structure reveals itself. What Bain bought is not a growth stock with wide-open upside, but a defensive asset whose upside has already been pressed down once by the market. Those brands on the bathroom shelf I mentioned at the start, Tsubaki and Fino, Senka and Uno, Agdeo 24, and Kuyura, are all mass-market brands that Shiseido deliberately spun off in order to focus on its prestige business. Mass personal care is a category with extremely low switching costs. The financial and psychological friction of switching shampoo or foam cleanser brands is essentially non-existent. In a structure where K-beauty, local brands, and retailers' private label products are constantly eating into shelf space, the moat around these brands stays at the shallow level of name recognition and shelf presence. Trying to slap a growth premium on an asset like this and take it public. No wonder both attempts fell through. That was hardly a coincidence. So the actual center of gravity of this deal structure becomes clear. First, whether the margin CVC finished building holds up after the acquisition is what decides the life or death of the entire valuation premise. And here, the point that must absolutely be questioned is this. Was the sharp margin rise from 15.5% to 21% a structural improvement, or was it a harvest-style earnings optimization engineered by suppressing advertising and marketing? Spend ahead of an IPO or a sale? If it's the latter, then this adjusted EBIT is inflated, and the 8 times Bain paid was in reality a far higher multiple. Second, the entire upside of this asset is held hostage to a single uncontrollable variable, the Chinese market and Sino-Japanese relations. As of the first half of 2025, China and Hong Kong account for roughly 36% of revenue and Japan for about 44%. And the fact that this nearly 40% of Greater China revenue slammed 2 IPO windows shut for political reasons proves that this deal's valuation is subordinate not to economic logic, but to diplomatic logic. In the end, the real driver of the Fine Today deal is a structure of buying cheap and not losing. Bain used CVC's pressure to sell, its fund's maturity and 2 failed exits, as leverage to enter at a discounted price. It secured 100% of the equity, taking full control over the board and over exit decisions. But in this structure, the upside, a re-rating of the multiple through a fresh IPO, and the restoration of the Southeast Asia growth narrative, only kicks in once China risk normalizes. The brands on the bathroom shelf remain the same, but 40% of the cash those brands generate still rests on the uncontrollable variable of diplomatic relations. Part 3. Governing Logic. Why they bought at 8 times and took 100% of the equity. A design built for defense, not growth. A designer builds structure not to make a profit, but to avoid losing. Apply this proposition to the Fine Today deal, and the reason Bain Capital acquired this company on these terms comes into sharp focus. To state the conclusion first, this structure is overwhelmingly weighted toward downside control, the question of how to defend the principal, rather than toward an exit narrative, the question of how to sell. And the reason is that the entire upside of this asset is held hostage to a single uncontrollable variable, the Chinese market and Sino-Japanese relations. The less a designer can control the upside of an asset, the more instinctively they deploy capital in the direction of seizing the downside. The first line of defense is the entry price itself. As we confirmed in the previous phase, the acquisition price of roughly 200 billion yen works out to about 8 times on an annualized first half 2025 adjusted EBITDA basis. Given that global consumer staples typically trade in the low to mid-teens, this entry multiple is itself the first margin of safety. Bain didn't get this discount for free. It manufactured it by using the seller's weakness as leverage. CVC, facing the maturity pressure of CVC Asia Fund 5 and burdened on top of that by a track record of 2 failed IPOs and 1 collapsed sale to a Chinese buyer, was in effect a forced seller with no time. When a seller is racing against the clock, the buyer holding the advantage on price and terms is the most basic law of physics in private equity deal-making. The second line of defense is complete control through securing 100% of the equity. Bain acquired not a minority stake, but the entire company. This is not simply greed for a bigger share. It's a structural choice to seize full control of the board and of every core decision: exit timing, M&A, dividends, capital expenditure. The more an asset's upside is subordinated to external variables, the more the logic dictates handing over not a single grain of the decision-making power over when and how that asset is recovered. Had it been a minority stake, then when China risk detonated, Bain wouldn't have been able to control even the timing of the exit. It would have gotten tangled up in conflicts with other shareholders. The third line of defense is risk transfer through contractual structure. This part hasn't been disclosed, so it belongs to the realm of inference, but in a secondary buyout of this scale, there are devices a designer will always insist on securing: warranty and indemnity, insurance to guard against breaches of representations and warranties, special indemnities for specific contingent liabilities, escrow deposits, and the like. In this deal in particular, there are 2 core risks that need to be transferred. One is the regulatory and tax-related contingent liabilities, latent in the China business. The other is any residual debt or transition services agreement obligations that may have been left over from the carve-out process out of Shiseido. Rather than have its own fund absorb these known risks, the designer seeks to pass them back to the seller, CVC, or to a third party through the contractual structure. What's worth noting here is that post-merger integration risk, PMI risk, is relatively low. That's because over the past 5 years, CVC had already built out the infrastructure of a standalone company spanning R&D, manufacturing, marketing, and sales. What torments a designer most in a typical carve-out deal is precisely the separation of systems and the establishment of organizational independence. And this asset has already passed through that painful stage. The implication is clear. In this deal, the center of gravity of risk lies not in internal integration execution, but in the uncontrollable domains of external geopolitics and margin durability. Bain's capital deployment ultimately reduces to a single consistent sentence: leave the upside to the heavens, but seal off the downside with a triple wall of an entry price discount, complete control, and contractual risk transfer. Now let me dismantle, from the standpoint of careful skepticism, the 2 fatal detonators that can neutralize even this defensive wall. The first detonator is the risk that cannot be contractually transferred: the authenticity of the margin itself. An adjusted EBITDA margin that surged 5.5 percentage points, from 15.5% to 21%, in a single year, is an extraordinarily fast pace for the consumer goods sector. If this improvement was not genuine cost innovation, but rather harvest-style earnings optimization, engineered by artificially suppressing advertising and marketing investment ahead of an IPO or a sale, then this adjusted EBITDA is an inflated number. In that case, the 8 times Bain paid was an illusion, and the real multiple was far higher. And the first margin of safety I described earlier evaporates into a mirage. This risk cannot be blocked with warranty and indemnity insurance because it's a problem in which the very premise of the valuation collapses. The second detonator is the single point of failure, where Greater China revenue concentration and Sino-Japanese relations interlock. As of the first half of 2025, China and Hong Kong account for roughly 36% of revenue, meaning this nearly 40% of cash flow rests on the uncontrollable variable of diplomatic relations. This is not hypothetical. 2 IPOs have already fallen through due to geopolitical factors, and even the attempt to sell to a Chinese acquirer collapsed amid Sino-Japanese friction. In other words, this risk is not a tail risk that might someday go off. It's a standing risk that has already ignited 3 separate times. This is where the chain of the butterfly effect begins. If China revenue is damaged, EBITDA declines. If EBITDA declines, the exit multiple falls in tandem. As a result, debt repayment slows, the return on investment plunges, and ultimately, the exit itself becomes difficult, resulting once again in a game of pass the parcel, handing the company off to the next private equity firm. The more chilling point is that even the diversification into Southeast Asia and halal markets, presented as this deal's sole escape hatch, is not a safe zone. With K-beauty and local brands already eating into Southeast Asian shelf space, moving out of China simply means entering another red ocean. And the fact that Bain won the auction by beating out competitors like KKR and Blackstone on price constantly raises the possibility that the highest bidder ended up saddled with the winner's curse. To sum up, this deal's triple defensive wall does fend off the known risks, but the 2 detonators of margin authenticity and China dependence are aimed from outside that wall, directly at the heart of the valuation. Part 4. Syndicate Application. The technique of buying the margin CVC already finished building. Now we arrive at the very reason this video exists. Up to this point, we've dismantled how Bain Capital acquired Fine Today from CVC, and why the center of gravity of that 200 billion yen structure rests on defense rather than growth. But here, most viewers close the window thinking, I don't have 200 billion yen. I don't even have 20 million yen. So what does this have to do with me? That's precisely the point where the designer and the consumer part ways. Capital is merely the result of this structure, not its cause. The real asset running through this deal isn't money. It's 3 structural logics, and you can steal and use them today even without capital. The first logic to put to use is the technique of acquiring an asset someone else has already finished building. Bain didn't grow Fine Today up from the ground. It simply bought an already finished asset, one where CVC had spent 5 years rebuilding the organization and lifting the margin from 15.5% to 21%. If you were to build your own deal room, you'd apply this same principle directly to content and community. Instead of straining to grow a brand new channel from bare ground where no one is watching, you'd hunt for the newsletter with a proven audience and accumulated trust that's been neglected or whose operator has burned out. The small community. The abandoned dataset. The one who buys a finished margin offloads the risk of growth onto someone else and simply redesigns on top of it. This is the only lever that saves you the capital called time. The second logic to put to use is the technique of converting the seller's time into your own negotiating power. The reason Bain could enter at a discount wasn't that Bain was smart. It was that CVC was a forced seller racing against the clock, pressured by fund maturity and 2 failed IPOs. The one who sets the board reads when the other side is at its weakest. If I were to apply this logic to a personal deal room, I would sit down at the negotiating table only when the other side is in a hurry. The freelancer whose contract is about to expire. The studio scrambling for staff ahead of a season deadline. The startup that desperately needs a specific capability right before a funding round. Their deadlines are my entry discount. When you're at a disadvantage, you negotiate not when the other side is relaxed, but when the other side is desperate. And designing that timing is itself a force that substitutes for capital. The third logic to put to use is the arrangement of giving up the upside while never, ever handing over the downside and control. Bain secured 100% of the equity, taking full control of exit and decision-making, and through the contractual structure it seeks to pass known risks, China regulatory contingent liabilities, residual carve-out debt, back to the seller. The more the upside is bound to uncontrollable variables, the more completely you seize what you can control. If I were to build my own syndicate without capital, I would design the board in a way that secures control over the outcome rather than promising the size of the outcome. When entering a collaborative project, instead of demanding a large equity share, I secure veto power over core decisions and over the timing of recovery. The principle of risk transfer applies like this. The tail risks I can't absorb, say, the other party walking away, or a copyright dispute over the deliverable. I pass to the other side in advance through representations and warranties clauses in the contract. The one weapon available to someone without capital is the power of the one who designs the frame first. And the moment you seal off the downside and seize control within that frame, you become the owner of the board even without money. To sum up, what you should take away from the Fine Today deal is not the number 200 billion yen. It's 3 structural grammars. Acquiring a finished asset to sidestep growth risk, converting the other side's desperate time into your own discount, and completely seizing the downside and control as the price of giving up the upside. These 3 exist not only in funds, they can be transplanted exactly as they are into every collaboration, project, and community you take part in. Capital is the result of structure, not the ticket to enter. It's the one who understands structure first, who ultimately summons capital, not the other way around. Part 5. Closing. Finished margin and control. The blueprint. Fine Today leaves behind. The essence of the Fine Today deal was not a growth story, but a blueprint for defense. Buying an already finished margin at a discounted price, leaving the upside to the heavens and sealing off the downside and control with a triple wall. And what we should steal is not the number, but the structural grammar itself. Acquiring finished assets, the negotiating power of timing, and the seizure of control. Understanding this structure doesn't mean you can break into the entrenched, ossified private equity cartel or into the vested interests of the aging consumer market Shiseido cast off. What it does mean is that once you understand this structure, you can design a syndicate of your own. We are not information consumers. We are structure designers. We don't stand at the door. We design the door. Structure, syndicate, restricted. IC feed. End.